Hello and welcome to another episode of the Solve to Evolve podcast. The purpose of our podcast is to help you, the individual taxpayers, investors and business owners, by sharing our insights about what's going on in Australia today. I'm Phil, got my fellow solvers with me, Bloxy and Jono. Gents, how are we?
Good, Phil. Yourself?
Yeah, not too bad.
Very well, thanks, gents.
Excellent.
We should mention we're recording from the Snug Bar in Gaimea.
Yeah, once again, we're here. It's a very nice bar in Gaimea.
Lovely Irish pub.
Definitely come
Check it
down and
out.
grab a beer. All right, guys. So there are a lot of things happening within Australia today, but I wanted to, in this episode, we want to cover tax. And really it's about topics around tax that, the viewers might not be aware of, or their accountants might not be speaking to them about on a regular basis. And so the three topics or talking points: carry forward concessional headroom contributions, Div 7A interest rates, and the tax penalty amnesty scheme. So we'll start off with the carry forward concessional headroom contribution. So this was introduced back in 2016 by Scott Morrison, who was at the time Turnbull's treasurer. And for the viewers out there, they might be thinking, what the heck is that? Why don't we first start by defining what a concessional contribution is? Chris, in simple terms, what is a concessional contribution?
Thanks, Phil. A concessional super contribution is one that anyone, either your employer or you personally, have deducted or can income tax deduct when you put it into your super fund.
Yep, makes sense. That's very clear. So deductible super contributions.
That's
Tax
right,
purpose.
Phil. And there's caps on this. So at the moment, the concessional cap is $27,500 per year per taxpayer member.
Makes sense.
So your employer can put in $20,000 and you can put in another $7,500, and then you'll have used up your whole concessional cap for the 2024 financial year.
And Chris, what's the headroom that we're talking about?
Sure. Thanks, Jono. So headroom is where if in a particular income year you've concessionally contributed or had concessionally contributed on your behalf by your employer less than the cap, then the difference between what was contributed, let's say $20,000, and the cap, let's say $27,500. So that $7,500 is what's called headroom. And that headroom can be carried forward by you for up to 5 years.
Yep. So basically, if you haven't put up to the cap in the past 5 years, you can now use that up now in the current year.
That's right. So the reason why this is important is because the first sunset date for utilising your carry forward concessional headroom is 30 June 2024. So in this current financial year, if the viewers have not utilised their concessional headroom from the 2019 financial year, they will lose the ability to claim the personal income tax deductions for that carry forward headroom as from 1 July 2024. So it's a use it or lose it system. And the first sunset date is 30 June 2024, which is rapidly approaching. That's why we're hammering this issue now for our clients and the viewers out there who may not be aware. This scheme is extremely concessional, which obviously can cause some concerns given the current regulatory environment of rolling back concessional schemes by the Labor government.
So when you say concessional, it's in the individual's favour. It's in the taxpayer's favour, right?
That's right. So right now, if any of you taxpayers out there, that you viewers have carry forward concessional headroom from any of the past 5 years, but in particular the 2019 financial year, you can basically take cash savings, contribute that into your super fund or super account if you're in a retail fund, and fill in a form called a notice of intent to claim the deduction. And you can personally deduct the amount that you contribute into your super account straight away. So in the 2024 income year.
Yeah, that's a really good point, Chris. So obviously, we are bringing this to the viewers now just so that they can actually start saving towards that if they are thinking about utilizing this strategy. And the one thing you touched on is to it is a use it or lose it policy. So it is looking back 5 years in terms of the headroom or the cap available for you, but you at a minimum would like to or should be utilizing the headroom in the first year or the 2019 year.
That's right, Phil. And it's important for the viewers to understand that if they make a personal concessional contribution and they have carry forward headroom, that concessional contribution will be offset against the earliest headroom in time before the latest. So it's a FIFO situation. So you don't have to actually nominate what year's headroom you're contributing against. It will automatically go against 2019. And then if there's more than the 2019 headroom cap, then it will automatically go to the 2020, 2021, 2022, 2023.
Yeah. And so as an example, let's just say there's an individual who has not had any concessional contributions of super over the past 5 years. They could, in effect, if they had to cash for it, contribute, say $100,000 this financial year and effectively gain a tax deduction for.
That's correct, Phil. So if you have a big capital gain in the 2024 financial year from the sale of a property and you want to reduce your taxable income, one strategy that you might use is contacting your tax accountant or just going online on MyGov, linking your ATO accounts to your MyGov profile and then clicking through to the super option and then clicking on the drop-down list, the carry forward concessional headroom option, and it will actually set out there how much carry forward concessional headroom you have. As Phil has just correctly said, you can then contribute that amount of cash from, say, for example, a big capital gain that you have on a property sale to reduce your assessable income by that deduction amount in the current financial year. So it's a very potent, as we said before, very concessional strategy.
Yeah, it makes sense. So reducing your assessable income, meaning that you're reducing the amount of tax you actually have to pay for that particular year.
That's right, Phil. There is an important restriction the viewers should be aware of. So it only applies to members who have a super balance of under $500,000. So relatively low balance. And the cash that is contributed, so an important rule is that the cash contribution must be received by your super fund before midnight on 30 June 2024. So it's not enough to simply transfer the cash on the 30th of June. Actually, the trustee of the super fund has to actually receive that cash into your account before midnight on 30 June for you to be able to claim the deduction in the 2024 income year. So a couple of important rules there. And like I said before, everybody should log into MyGov, link their ATO accounts to their MyGov profile, click through to the super option. There's a drop-down list where you'll be able to click on the carry forward concessional headroom balance that you have. You can actually see the amount there in a very simple to read reconciliation. And then you should ask yourself, or you should educate yourself online or talk to your tax accountant, give us a call, and we can explain to you how you can utilize that in terms of deducting the carry forward headroom amount in the current income year. It's a very important strategy that you may choose to avail yourself of.
That's right. That's right. Viewers, get onto that right now. Thanks, Bloxy, for that one. So moving on to the next talking point, we're all aware of the interest rate rises over the last 12 months, and that's really stemmed from the cash rate rises by the RBA, which has been passed in full by the banks. But what business owners out there might not be aware of is that the ATO have also increased the Div 7A benchmark interest rates. Now, Jono, can you tell us a little bit about, firstly, for the viewers out there that don't know what Div 7A is, can you touch on that and then tell us more about the interest rate rise there?
Yes. So Division 7A, that's a tax code term, but basically what it is where you're a business owner or shareholder in a company that you own, private company, and you've taken loans from that company to either fund personal expenses or you've just taken drawings out over and above what you've paid yourself as a wage. So that's who this would apply to. Typically it's business owners. And the way to check is to look at your accounts and if there's any loan, what's called a loan account, director loan or drawings account, you would see that on the balance sheet. So what I'd like to raise and mention for people is for FY24, the interest rate on those loans that you take from your company has increased up to 8.27%. So that's a massive increase from the last year when it was 4.77. So it's a strategy that you need to be wary of now that there's that interest cost.
Yeah, and just to confirm to the viewers out there, businesses can operate in different structures, but what we're talking about here specifically is businesses that are operating through a company structure.
Yeah.
And when you speak about a director's loan, we're talking about money that has been drawn out of the company by a director or the associate of the director, which means that when you're looking at the company balance sheet, it's money that's owed by the director to the company.
Yeah, so you need to, when you have a company, you need to think of it like a separate person. I'm a human.
It's a separate legal
My
entity.
company, Solve Accounting, is a separate person, really, at law. So you should view it that way. And if you've taken money, the human's taken money, then you're going to have to deal with this Division 7A tax code.
And just to hammer home Phil's point, so this Division 7A, Jono, it wouldn't apply to, for example, a trading trust or a partnership. Is that correct?
Yeah, you've got the company credit card and you go out for a holiday, you see some nice gifts that you want to buy for your wife or your partner, then you use the company credit card. That's going to become a loan. Your bookkeeper, your accountant will treat it as like a loan because it's personal use. It's not
personal
company.
Drawings, yeah.
So the shareholder borrows money from the company for private, non-business purposes.
Yep, that's right.
Now, Jono, there are a lot of business operators that probably start out as a sole trader. And so in this scenario here, they're quite used to receiving money into their their business accounts and then spending money on personal, as you say, or personal use. And obviously that situation there, Div 7A doesn't apply. But when they then change the operating structure into a company and they continue to do so, that obviously will lead to higher director loan balances because now the accounting treatment for that transaction is different, where you're now borrowing money from a company, a separate person, a separate legal entity. For those business owners out there, what are the implications of a Div 7A loan? They've drawn out the cash. What they should be doing is paying the money back, either by cash or through the form of a dividend declaration. But if they don't do that, what are the implications?
So where it gets bad is where essentially that loan has to be treated like it's a commercial loan. Think of it like a personal loan. If you went to the bank and got a personal loan to spend some money, then you'd have a loan agreement. You'd have to make repayments on that loan. So the same applies here where it's your private company. So some paperwork needs to be done to make sure that you're making those, or you have an agreement.
Yeah, you're commercializing the loan and now more admin fees are involved.
Yep, exactly. And that's where, so why I'm raising it for this year is the interest rate on that is now 8.27. And that's interest that is effectively going to have to be paid to the company and it's taxable to the company. But if it's personal use, it's not tax deductible to you.
Yep.
So that's where it can get bad. And also, if you don't have all that loan documentation in place by the end of the year, it can give rise to really bad tax outcome. The worst outcome is when you don't have that and that whole amount, that loan is treated like it's a dividend and the human gets taxed on it.
Straight away, and they're up for a big tax bill.
And Jono, if you receive a deemed dividend from a company because you haven't made the minimum principal and interest repayments in time, can that distribution be franked or not?
Generally not. So you're talking about using the tax that the company's paid and attaching that to the dividends you pay out. So in that scenario, you can't do that. So it's a double hit if you pay tax in the company.
Big issue. It's a big issue there.
Yeah, and ultimately so that you can't strip out cash from your company tax-free. It's got to be taxed at some point, and that's why those rules are there and in place.
Yep.
Thanks, Jono. That was very interesting. Now moving on to the next topic for discussion. Phil, so small businesses have had it fairly tough over the past 3 years. There's been lockdowns, COVID, floods, then inflation. Interest rates are now spiking up. And this is going to be affecting the bottom line of a lot of our small business clients and a lot of
Viewers
clients
out there as well.
viewers watching.
Yep.
It's most likely may have led some of you to drag your feet a bit and have maybe a small or an outstanding lodgement or even a tax debt with the ATO. Is there any relief out there for small businesses, Phil, that you can enlighten our viewers on?
Yep. Yeah, there's one. So the Tax Penalty Amnesty Scheme. So as of late, and we've probably noticed this over the last few years as we have gone through the various crises you have listed, the ATO has been quite lenient in terms of chasing the tax debt. But what they've said is as of March 2023, about 65% of its collectible tax debt, or $30 billion, was held by small businesses. And so as we all know, the ATO is the revenue arm of the government, and they need to start collecting their debt. So what they want to do is re-engage the taxpayers. So there are small businesses out there dragging their chain, they're dragging their feet in terms of getting lodgements up to date because they don't want to face their tax debt fears because they understand that there's probably debt to pay and they don't want to lodge. But recently in the 24 federal budget that was released, the Tax Penalty Amnesty Scheme was introduced as a kind of a last olive branch to taxpayers to try and re-engage them. And what that means is the ATO is willing to waive failure to lodge penalties on certain overdue payments held by small businesses. So for our small businesses out there and the viewers behind on their lodgements, it's a good chance for you now to take advantage of this because ultimately you will, at a point in time, will need to get your payments up to date. And why not take advantage of this amnesty? And so what that means is generally, if you are late on lodging your BASs, your FBT returns, your income tax returns, you could face up to $1,000 per lodgement.
So Phil, who does this amnesty apply to?
So the amnesty is applicable to small business owners that has an annual turnover of less than $10 million when the payment first came due. So this payment only, or this amnesty only applies to income tax returns, fringe benefit tax returns, and business activity statements that were originally due between the 1st of December 2019 and to the 28th of February 2022.
That's basically the COVID period.
Yeah, that's right. So they are
right.
providing a concession for that period. So if small businesses are or have overdue lodgements, what they want to do is to make sure that they are attending to those outstanding lodgements. So that's re-engaging with your accountant, or if you're doing it yourself, then during the period of 1 June 2023 to the 31st of December 2023, bring all your lodgements up to date and you would be able to get access to this scheme.
So that's how our small business viewers out there can actually access the penalty amnesty scheme.
Yeah, it's pretty simple. So all you need to do is just pick up the phone, speak to your accountant and just say, I do need to get my lodgements up to date. Now, I guess if you're thinking, Stufford, I don't want to, what's the implications there? One, if you leave it to a later date, what will occur is one, the ATO will start to ramp up their debt collecting activities, meaning that they will start to send you out reminder letters, start calling you, adding on the failure to lodge penalties, general interest charges on debt that you may have will start to build up. And so there will be a point in time where if you don't re-engage at this point, you're going to be faced with a bigger amount or a larger size in terms of your debt. And it might be harder for you to then get on top of. And so that may lead to business failure. For the viewers out there that own a small business that haven't lodged their tax lodgements, please bring up to date before the end of this calendar year, 31st of December, 2023.
And does the ATO expect, say if there's tax liabilities on those lodgements, do they expect some payment of those before penalty will be remitted or?
Yeah, so the penalty itself, no. If you have brought your lodgements up to date, those failure to lodge penalties will be waived. So I just want to make it clear that this is waiving failure to lodge penalties. What you mentioned just then in terms of making early payments or making payments towards a debt, that will, of course, reduce the amount of debt, but also reduce the amount of general interest charges on the account. So this is just purely waiving failure to lodge penalties for outstanding lodgements relating to payments.
Yeah. So if you have debt sitting there, you may need to enter into a payment plan as well.
That's correct. The ATO are pretty lenient. Ultimately, they do want to collect the debt that is outstanding to them or owing to them. So they're pretty friendly when it comes to coming up with a payment plan for a taxpayer, making sure that they ultimately, you don't want them to fail, because if they fail, you're not going to collect the debt and it goes to liquidator. They've got to come to an agreement and they don't get their money back. So ideally, they do want to negotiate with the taxpayer. They want to make sure that you are making some sort of payment towards the debt. And it doesn't matter if it takes a couple of years to retrieve it, because ultimately they will get that debt in full.
Good one, Phil.
Excellent. Thanks, guys. That's all we have time for in today's episode. Thank you again for joining us. And if you learned something, viewers, please share this podcast with your network. We would love if you also left us a rating and review. Until next time, peace.